All right, so recently it was announced that Warren Buffett and obviously Berkshire Hathaway is buying Chubb. CB is the ticker symbol. Now, again, this is an insurance company on the larger end, $111 billion. Now, I would preface this by saying I had this on a watch list for a while now. I don't have it on the Stock Unlock watch list, but I have it on both my personal ones. And I think it's a good company, and honestly, looking back, I'm not sure why I didn't buy it, because as I dug in deeper, I wouldn't say I really like it, but I definitely do like it. Honestly, I think the reason that I didn't buy is because I already have Primerica, and I probably thought that they were a little bit better. And again, I'll break those down as well. But again, first things first here, again, obviously this company went up very, very drastically because it was announced that Buffett bought it, again, up about 8.5%, give or take, since that was announced. I mean, year to date, it's up very significantly, about 21%. I guess that's not crazy high, but again, for a large cap insurance company, that definitely is. First thing I notice here, a 12% free cash flow yield is very, very good. Again, I'm not going to get into the description because, again, it's just their insurance company. First things first, if we look at analyst ratings, again, they're actually right around where it is. Right around 275 is the average. So again, I'll get into my value, but again, I think it's right around fair value where it's at right now, and I'll get into that. Why? As far as the dividends go, again, 1.25%, the payout ratio is about 10 to 15% based on which metric you go on. They're only growing at about just over 3% per year, which honestly, I don't know why they're not growing it faster, but again, that's just what they've done. And again, if they can consistently do that, honestly, it's not that bad. If you go back 10 years, you would have about a 3.5% yield on cost, which again is very nice. So again, they've provided very consistent returns. If you go back a decade, they're actually very close to the S&P. 203% versus 216, so basically the same. If we go back 5 years, again, almost exactly the same as, again, 98 versus 100. So this is a company that historically has performed almost exactly how the market has. So again, if we look at the financials, again, this is the bread and butter right here. Income statement. First things first, they've more than doubled their revenue over the last decade, which honestly, it looks like they've grown virtually every single year, which is exactly what you want to see. If we look at net income, again, that's a little bit sporadic, but again, they are at an all-time high, which is exactly what you want to see. Same goes for earnings per share. Shares outstanding, again, with that high of an earnings yield, and you're not paying a high dividend, you better be buying back a good amount of shares every year, at least 1 or 2%, I'd say, which honestly, it looks like they have been doing. They did issue a lot of shares, looks like in 2016 for whatever reason, and 2017. Ever since then, they've been buying back, looks like they've been buying back roughly 5 to 10,000 shares per year, not 5 to 10 million, not 1,000, which is exactly what they should be doing. I think they should be doing a little bit more even. I don't see why you can't be doing, I'd say, maybe 2% per year, just number off the top of my head. But again, that's just me. So again, if we look at the metrics here, again, operating margin 19%, net margin 18%. Those are good numbers. But we would notice, again, these are on the higher, at least going back about a decade, these are on the higher end of those. I mean, maybe about average, depending on how you want to look at it. If we look at return on equity, return on invested capital, again, those are both at basically decade highs, which again is what you want to see if you're going to be buying it. If we look at, again, revenue per share, again, going up very, very nicely every single year, that's exactly what you want to see. Book value, again, also going up virtually every single year, also at an all-time high. That's exactly what you want to see. So if we look at the insights, again, the growth is exactly what you want to see. They've been growing very, very nicely, especially for an insurance company. Again, financial health, pretty good. I wouldn't say great, but pretty good. Again, and it looks like they are buying back about 2% per year, although, again, I believe that is just for last year, so we'll see. Again, one concern here I have is earnings for next year are projected to basically be flat. So that's something that is kind of questionable. Is, hey, why are you buying it for that reason? But I think the reason is next year, okay, maybe the earnings won't be great, but over the next 5 to 10 years, I think they're looking pretty good. Again, PE of 12, that 5-year average is 15. So that's a pretty significant discount to that 5-year average. PEG ratio, again, is very high, but again, that's because the earnings are not projected to really go up. If we want to get into my fair value here, again, if you look at the numbers here, again, they've grown earnings at 11% per year going back about a decade. If we go back exactly a decade, they've grown at actually at about 9%. But again, if you go back to 5 years, they're actually growing faster, right? About 23% per year. But again, that growth has kind of been a little sporadic over time. It hasn't been super consistent. So it's kind of hard to project, in my opinion, how this company is going to perform. If we look at the PE, again, that average about 15. Again, it's currently at about 12. I mean, the lowest it's ever gotten is just under 9. So I think that if you can get it for, let's say, a 10, 11 PE, to me that's a steal of a deal. And I mean, if you look at that 9 number, again, that's consistently been right around as low as it goes. So again, if you can get it for a 10 or 11 PE, in my mind, that's where you really want to be buying it. If we look at the valuation here, again, if you assume that it's going to grow earnings at 10% per year, its shares outstanding are going to be flat. I mean, let's just go based on that 10-year average. They're going to grow 9% per year. They're going to buy back 2% of shares. They're going to grow the dividend at, let's say, 3.3% per year. 12 PE. Actually, let's maybe go 11 PE just to make sure we get that discount. Again, that still has you growing at more than 10% per year. It is the fair value above where it's at right now. Even if you pay a 10, that means we're still basically about fair value. So I think that, again, if you can get this company below 270, from what I can tell, it looks like it's a buy. It's currently at about 275. So again, let's compare it. Just last thing here, let's compare it to Primerica, which is the insurance company that I have right now. There is one that I really, really want to buy. It's just too expensive right now. Again, profitability, Primerica is better by a decent amount. And I mean, an operating margin of 26 or 27 versus 19. Net margin, it's just slightly better. Management, again, the return on invested capital, 17% versus 12 for Chubb. Return on equity, 26 versus 15. The 5-year returns, Chubb has outperformed. Growth is something where Chubb definitely takes the win there. Financial health, Primerica is doing a better job there. Same with dividends. Again, they're growing it faster and the dividends higher. Analysts, again, Primerica is projected to go earnings 10% versus basically nothing for Chubb. And not only that, Primerica looks to be a little bit undervalued where it's at right now, at least according to analysts. The PE of Primerica, 13 versus 12. So again, it is trading a little bit more expensive, but if it's projected to grow a little bit faster, then it probably should be a little bit more expensive. And not to mention, too, the PEG ratio is 1.28, which is pretty good, actually. So anyway, like I said with Chubb, very good. I wouldn't say very good. I would say solid company. And not to mention, too, I've talked a lot before about how I think insurance companies are a good buy right now if you pay a fair price, because with higher rates means higher premiums, which means more earnings for insurance companies. So if you can find some of these good quality insurance companies at a bargain, to me, it's a no-brainer. And not to mention, too, it's a good way to diversify. I mean, most average people out there, they got their tech, they got their consumer cyclical, like they got a lot of those kind of stocks. But if they have financials, typically it's going to be like a Visa or even like a bank or something like that, maybe one of the payment processors. But again, do you have an insurance company? So in my mind, I really like some of these insurance companies because of that. Because again, there's some diversification there, and I think that some of them, again, with the higher premiums, I think that's going to help out a lot with that top line growth. So anyway, that is what I think of Chubb. Again, Where Warren Buffett bought it, when they first announced it, I think it was around $250 a share. So I for sure would be buying it at $250. Like I said, $270 is probably roughly the fair value. So again, it's right around fair value right now. But again, if you could get it for $250, for sure I'd be buying it. Even below $260 probably was when I would start to get interested. But I would want to get it for, like, let's say an 11 or below PE, because for me that's a pretty clear discount. So again, that's where my buy would be personally. But again, even if you buy it where it's at right now, I still think you're going to get decent returns. So anyway, that is my thoughts on Chubb and the recent news. Again, if you liked the video, please like, comment, subscribe, and stay tuned for more.